Market chaos is back. For 2 years of a smooth ride in stocks, the VIX volatility index, the market's fear gauge, fell to multi-year lows, only spiking a few times on brief dips, but then surged 91% this month to its highest since March of last year. Along with it, fear that the hottest stocks in the market are too expensive sent the Magnificent Seven crashing, with Apple down 3%, Amazon and Alphabet losing 8%, Tesla dropping 12%, and Nvidia down 21% just in July. All you out there in the Bowtie Nation know I think this bull market keeps charging, and I've shared why in recent videos. But you cannot ignore the risks in those stock prices, and especially the increase in whipsaw movements. There have been 9 days of 1% or more swings in the last 3 weeks. Half of the trading days, investors have been whipsawed back and forth. That is the most since the August-September period last year, when the market fell 9% in 3 months. But there are stocks that win on market chaos, stocks you can buy not just for safety from the drop, but also for that higher upside returns. I'll detail 7 stocks to watch, as well as an investing strategy that can produce double-digit returns on any of your stocks. And let's get started with CBOE Global Markets, ticker CBOE, a global leader in derivatives products and market exchanges. Derivatives are things like options and futures trading, so investments that track stocks and other assets that can be used for hedging and returns. So think of it like the New York Stock Exchange or the NASDAQ. It, along with the other market exchanges we'll look at, makes its money through trading volumes on stocks or options listed, as well as market-making activities. The exchange makes money on transaction fees for options and indexes listed as well, so as that trading volume spikes with the market chaos, so do the fees. This is especially true for the CBOE, which created the VIX Volatility Index, that measure of market swings, so the CBOE gets fees on trading and licensing of the VIX. And it's not just this stock market volatility. Global geopolitical risks, economic pressures, and a number of factors can cause investors to rush to options and those other hedging instruments to protect their portfolios. CBOE shares jumped 6% on its first quarter earnings in early May, when the exchange beat earnings and revenue forecasts. Earnings are expected up almost 11% this year on an 8% increase in revenue, but could beat on that recent volatility. The company reports its second quarter results on November 1st, with the shares already up 20% since July 10th, when that market volatility really started heating up. So some of that upside is probably priced in at this point, but as long as those market swings persist, the CBOE will be printing money. NASDAQ Inc., ticker NDAQ, is similar to the CBOE and probably more familiar to most investors. The exchange is a favorite for tech stock listings, as well as penny stocks for its more lenient listing requirements versus the NYSE. Here again, the exchange makes money from trading fees, market data, settlement services for brokers, and index licensing. For example, the popular QQQ ETF Trust is based on the NASDAQ 100 index, so Invesco pays the NASDAQ a licensing fee to use that index. Another example, NASDAQ offers data and analytics on its exchange trading for use by hedge funds and institutional traders, like the Retail Trading Activity Tracker, following the stocks Main Street investors are buying and investor sentiment on each. Revenue is expected to jump 20% higher this year before settling back down to 7% growth next year. Shares are priced more expensively here versus the CBOE, with the NASDAQ trading at 39 times its trailing earnings, against a PE valuation of just 27 times for the CBOE, though both are more expensive than another exchange we'll cover later. Shares of NASDAQ are up 16% since that July 10th volatility spike, and this is a good long-term pick. But one development I would be watching is its purge of penny stocks on the exchange over the next couple of years. The exchange has come under fire recently for its lenient rules on those reverse splits and penny stock listings, and may be tightening those rules. It may not be at much loss to revenue, but it could show up on the margins in that lower trading and fees. The next stock I'll highlight pays a 16% dividend yield and won't follow stocks up or down, but another way to take advantage of the market volatility is through options investing. Because options premiums are priced on volatility, when that fear gauge goes up, so does the money you collect on options, as well as the downside protection you can lock in. Now I want to get back to our list, but to help you understand options and how to use them, I'm relaunching my Ultimate Options Investing course with a 38% discount. Save $150 off. I'll take you step by step into 29 strategies, including one that will make your money back fast in a losing stock. Over 3 hours of video, I start with the basics, then walk you through each option strategy, when to use it, and how to set it up, including real-world examples with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right option strategy and an options calculator to show you exactly what to expect. Right now, I'm relaunching the course at a 38% discount. Save $150 off, but only for the next 3 days. You're going to get those basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. That $150 launch discount is only available with the coupon code in the link I'll leave in the description below, so look for that link or scan the QR code here. This next stock isn't a company, but a way of benefiting directly off volatility. The Simplify Volatility Premium ETF, ticker SVOL, with its 16.2% dividend. Now bear with me here because this has to get technical before it gets easy. The SVOL works on a short volatility strategy, selling futures on the VIX Volatility Index. And again, volatility is just how much the market or a stock moves up or down in a given period, a gauge of stock market craziness. The Volatility Index, or the VIX, is the market's expectation for volatility over the next month, so how crazy investors believe stock prices will be. And while you can't invest directly in the Volatility Index, you can invest indirectly through futures, options, and ETFs, betting whether the actual volatility will be higher or lower than expected. But here, the SVOL isn't really making a directional bet. It's simply saying that market expectations for volatility are typically higher than actual. Shorting those expectations, so selling futures contracts against the VIX, is a way to capture that fear premium in the market. And the strategy is backed up by research, testing VIX futures shorting from 2005 through 2015, rolling the short contracts over each month, was profitable in 8 of the 11 years, with an average monthly return of 0.7% and a total return of 118% over the period. Beyond that research and the huge dividend, the biggest selling point for me, though, is that this is a totally different asset class. That premium from shorting the volatility index is reliable and robust. The VIX has a historically negative correlation with stocks. When stocks go up, the VIX goes down and vice versa. The correlation here is negative 0.84, which is very strong, and just means that using a volatility strategy along with your stock portfolio can be a great way to reduce risk. We're back to the exchange stocks with this next one, the CME Group, ticker CME. The company operates the Chicago Mercantile Exchange as a $75 billion leader in global derivatives and futures trading. And just like the CBOE, investors rush to the CME futures products to hedge volatility in assets from oil to currency and stocks. You can see that since volatility started increasing July 10th, daily volume has increased and open interest has jumped, all pointing to higher fee revenue for the CME. Shares are down for the year, but up 7% since that volatility kicked in, and the shares are still relatively cheap on a PE basis compared to both the CBOE and the Nasdaq. We've still got 3 more stocks that benefit from that market volatility, including one with a surprise upside coming, but I want to get your input on this as well. I've highlighted in recent videos why I think the bull market has a long way to go and why I'm still buying the dip. From the $13 trillion in cash and home equity sitting on the sidelines waiting to be invested to coming interest rate cuts, I think stocks continue that upward trend for at least another year. But what do you think here? Let me know in the comments. How are you investing in this recent market chaos? Are you buying or selling? And what stocks are you watching for those opportunities? Next on our list, S&P Global, ticker SPGI, wins the volatility game in a number of ways. The $153 billion financial data powerhouse operates in 5 areas. Indices like the S&P 500, which it licenses out for ETFs to track. Mobility, which provides data and analysis for the automotive industry. Commodity insights for research and data on commodities markets. Ratings, where it provides debt ratings and issuance for company bonds. And then market intelligence with market trading data and research. You can see in the second quarter performance that ratings is growing at a 30% plus, but none of the others are big movers, and yet the company was able to turn that into 14% overall revenue growth and 30% earnings growth. And as volatility and uncertainty in the markets increase, the big institutional investors start to get nervous, and they look for more market insights and data, and they look for it with SPGI. As financials start to weaken at companies, they need their bonds re-rated, and that means ratings revenue for SPGI. Shares are up 5% since the July start of volatility, but we're already in an uptrend, so it's hard to tell how much of this is priced in at this point. Revenue is only expected higher by 9% this year and 7% next, so could be understated on recent numbers. Earnings are also expected to grow at 14% annualized pace over the 2 years, so there could be room for an upside surprise. Here's a twofer in this next stock, the Utility Select Spider ETF, ticker XLU, with its 3% dividend, and the consumer staples sector SPDR, ticker XLP, with its 2.7% dividend. This is more of an indirect investment on volatility. As that uncertainty increases, stocks fall and investors start to panic. They rush to the safety stocks in the market, the stocks of companies selling things that we have to buy, so the ones with those safer cash flows. You can see how that affects stocks in each sector. Over the last month, the broader S&P 500 has fallen 4.8% as investors worry about the economy. Riskier consumer discretionary and tech stocks have plunged 9 and 11% into correction territory, and investors have rushed to that safety, pushing utilities up 3.5% and staples up almost 2% over the period. You can invest in the ETFs and get that broad exposure to those groups with the XLU, which holds 31 stocks in the S&P 500 utilities sector, or the XLP, which holds the 38 stocks in the staples sector. Or you can go to sectorspiders.com sector tracker to see which stocks are in each group and invest individually. In consumer staples, you're going to find household products, food, beverages, and tobacco like Kellanova, Philip Morris, Coca-Cola, and Campbell's Soup. In utilities, it's all those regulated and independent power producers, as well as renewables like Consolidated Edison, Southern Company, Duke, and Constellation Energy. Now, this next stock could have a surprise upside coming, but another way to beat market volatility is by collecting dividend cash flow every month. I've found 5 monthly dividend payers that won't let you down, along with 1 dividend stock every investor should buy, so make sure to check out this video next. The VanEck Gold Miners ETF, ticker GDX, and its individual miners could show surprisingly strong earnings over the next quarter. The price of gold hit an all-time high above $2,500 an ounce recently, and actually started breaking higher at the beginning of July. That is right at the start of the third quarter, and could mean current estimates for miners' earnings are still way underestimated. You can see here in research from S&P Global, the all-in sustaining costs, or AISC, for gold miners as of the fourth quarter of last year. That's the price the miners need to keep their companies going, so costs as well as capital spending, and you can see the median of $1,329 an ounce is well below that current price of gold. Some of my favorites like Agnico Eagle Mines and Endeavor Mining are producing at even cheaper costs. As volatility and uncertainty increase, investors rush to the safety of gold. At $2,500 an ounce, these miners are already hugely cash flow positive, and I don't think estimates have factored in that recent bump in prices. The GDX is up almost 10% since the price of gold started running, but there could be more upside ahead if gold can keep these levels. You can invest broadly across the group with the fund, or look into the holdings here to see which companies make up the biggest exposure in that ETF, like Newmont, Agnico, and Barrick. Get that special relaunch discount and save $150 off our Ultimate Options Investing course. 29 option strategies, the strategy finder, and the options calculator, so you know exactly how to use options. Look for that special coupon code for the relaunch discount in the description below, or click on the video to the right for the 1 monthly dividend stock every investor needs.